Hello, everybody. It is Monday, August 17th, and I am back from 4 days of contemplating in the woods. That's my story, and I'm sticking to it. Want to talk about investing here the rest of this year and really as we head into the 2020s. And I want to point out a couple of articles that I've released recently. The option selling ideas goes on both website, Fundamental Trends and Margin of Safety Investing. So I get lists from bar charts and I screen different ways from week to week. I've been looking at cover calls and cash secured puts that are 60 to 100 days out. The specific reason that I'm selling covered calls that far out, same reason that I did it a while back, is I want to collect all that time premium, all that time value premium as the market gets choppy. So I'm happy to sell things near the prices they are, but I'm also happy to own a lot of my stocks long term. So if I sell a covered call near the money and I collect a lot of time value, that's a way for me to work my way through the volatility. Cash secured puts, there's almost nothing out there that I want to sell cash secured puts on right now. So we're just looking for securities that are starting to trade that are 5 to 25% out of the money so that we can sell cash secured puts when the market corrects. So we'll be using a lot of good till canceled orders, not just entering a trade today and saying, oh, I expect this to hit today. Stocks are overvalued, and I will show you a whole bunch of charts at some point about that. So PTC, Avco, Berkshire Hathaway, Barrick Gold, Apple, Great Lakes Dredge and Dock, Caesars Entertainment, Disney. These are all things that I talked about, and you'll want to take a look at this. The other article that I thought was pretty worthwhile was the Stocks of the Week Quick Thoughts. I put up a couple of fact set reports on earnings. You should read these through to give yourselves a good idea of what's really going on. The short story on earnings is that companies have been beating their earnings estimates. Really, 5 out of 6 companies have. It's been huge. However, the flip side of that is they all lowered their estimates so low during Q1 that was basically all they had to do is stay in business to beat their estimates. So now they're dialing the estimates back up and the expectations are up again. So what does that mean for the stock market in the next quarter if they don't meet those expectations, which they almost certainly will not? Talked about Amazon. I think there's another clue that Amazon is going to spin off AWS at some point. They're in the process of buying Rackspace. I think they'll end up owning the whole thing, or they will do a reverse merger of AWS into Rackspace and call it AWS. We'll see. If you've been paying attention, you've noticed that Bezos has been selling a ton of stock as part of a program that he started in January. And he's also the guy that said Amazon would go out of business someday. His whole point with Amazon was that they didn't have competition for a very long time. Now suddenly everybody's competing, right? All these businesses across the country, across the world really, are suddenly going to Shopify or whatever WordPress or whatever web development and marketing solution that they can find, and they're competing with Amazon. So now some of the other shopping services really do a pretty good job of competing with Amazon without making it clunky. So I would expect that to continue. I think Google will probably make quite a bit of money, but things like Honey, which is tied to PayPal now, there's a lot of reasons to think that Amazon might not have the growth that it has had recently ever again. And then you take a look at the chart and it just goes straight up. Well, I think they've probably priced, they weren't cheap in here, but I think they've probably priced in all the growth that they're going to see for quite a long time. And could it jump up one more level? Yeah, for sure it could hit the 4,000. But, you know, anytime a chart gets parabolic like this, you better ask yourself a question: have the laws of economics been changed? Because what do we know about profitable industries and profitable sectors? What do they attract? What does a profitable industry attract? Competitors, right? That's Econ 101. So Amazon's getting a lot of competition now. And I'm not about to say that Amazon's going to zero, but I think that chart, I just don't know there's a lot of reason to own Amazon at these prices. I think that if there's a big correction into our buy zone, I would buy them, but specifically because of a potential AWS spinoff. The gold stocks ETF jumped up huge today. News that Warren Buffett had bought a stake in Barrick Gold. You know, that makes me very happy about with what I've done. I think that any pullbacks in gold should be met with buying, but, you know, make sure you pay attention to these levels and that it comes back to a reasonable amount. You know, so I said here that I probably wouldn't buy GDX until it got down to this area. But I think if I can get GDX at around 36, 37, I probably have to buy a little bit of it anyway, and then hope that I can get it at 32, 33, which may or may not happen. We'd have to get a good sell-off on a correction with margin calls. Teladoc was in the news today. I point out OnTrack, which is a stock that I put us on to. OnTrack has gone straight up since I freaking talked about it. You know, sometimes because of the way I do my screening, I just don't discover things quite early enough. And that's a shame because I think that this stock's going to do really well. So if it comes back to us, we're going to want to buy it. The niche that OnTrack has, mental health care, using online delivery, I just think that you could see these guys get massive government and healthcare contracts. So I think this is a very high stock on my list to get on track on a pullback. They're not profitable yet, so there will almost certainly be a pullback. Cisco's getting beat up. A price alert went out today. That doesn't mean I think you should buy it. In fact, I lowered where I would buy it. I lowered it down to about 36. You can certainly buy it here if you really want Cisco. I think the problem with Cisco is that their growth engine is starting to wear out. Lower revenues and profits. A lot lower revenues, but not lower profits because they've been firing people. At some point, Cisco has to be worried, and I think a lot of observers are. How do they compete at the cloud level with Microsoft, Google, Amazon? I'm not sure what they're going to do. Do they go out and buy an Iron Mountain and then sell off the legacy paper part of the business to get the data centers? I don't know. You know my feelings about Iron Mountain. I think they're poorly managed. I just don't think that they're doing what they're going to need to do to stay competitive long term. I mean, I understand what they tried, but again, they're beating up against Google, Amazon, and Microsoft on the cloud, and I just don't see them translating paper documents into cloud storage. Simon Property, remember back when they were like 3 times higher, I said sell them, and they're still on probation. But I think if they get into the 40s, if they retest, right, if they retest down in here, we have to start thinking about them. Why? Why if they retest back down in the 40s? Well, that $20 rally, I think, is just pie in the sky, everybody hoping things will go well. I think it retests pretty soon, actually. Does it go all the way down into the 20s, which is my concern? I don't know. But read this little blurb that I have here about what they're doing with the company. And one of the things that they're involved with is a joint venture with Authentic Brands to buy bankrupt retail chains. So basically getting brand names that they can get at low prices. And by the way, they also pay rent to Simon Property. So I think Simon Property has a chance to really do well on the redevelopment side. It's going to take time and money, but I think there's going to be a day where you want to take a look at Simon, not just as a dividend providing REIT, and they still do provide an income, but I think you're going to want to look at them as a growth play. Those mall campuses, I think, can become very interesting mixed-use properties if they're done well. And then Disney, they hit the 100 plus subscriber button already, but they are just getting killed because all their parks are closed. It's another stock that's resilient because of all the liquidity pumped into the markets. Back when it was here, and I told people that it could get down into the 80s and 90s, they told me, you're out of your mind. Well, it did. I don't know if it'll get all the way back down to here again, just because so many people love this stock. But if it gets under 100, maybe right at around 100, I think I probably have to buy it, because when the pandemic's over, hopefully by next year sometime, we have this dealt with, at the vaccination level. I was going stir crazy. I've been telling you that. So I'm getting, after just a few months, I'm tired of being stuck at home. I won't go to a bar. I've resisted that. We don't really eat inside at restaurants unless they're, a place that's really empty. But as far as vacationing and doing all the things that we like to do, that millions and millions of people like to do, that aren't getting done right now, there's going to be a whoosh of people planning trips at some point. And I think that demand will remain strong for years as people look back at what just happened or what is happening, and they say, you know what? I'm not going to put on hold doing things that I want to do. And I think that the millennials in particular are that way. And I think the Xers are that way. And I think the boomers, who have a lot of them been on hold from doing things lately, I think they're going to get out of their own way. And I think that they're going to, as soon as they get that shot, they're going to be like, okay, we need to start going through this bucket list. So I think there's a lot of people who have at least thought about the idea of mortality and how much time they have to do the things they want to do. And I think Disney's going to be a big beneficiary of that. I want to go to, I've never been to Disney. And we were going to go last September. We put it off to do something else. And now I wish I had been to the House of the Mouse, PayPal and Square. PayPal jumped today because David Tepper took a stake. But again, another parabolic chart. And remember, he bought it back in Q2. So he bought it in here. Remember those filings, actually he bought it in here. The filings from 13F filings for hedge funds, they're quarterly. So he probably has an average price on this stock of around 120 or less. And now it goes straight up. He's a trader. He can trade out of it too. The stock is way too high at these prices. Where's my buy zone? I'd sure like to get it under 130. Again, I don't know if that'll happen, but if there's a correction and we get this price, I think we have to buy it. Again, I mentioned them. I mentioned Honey. I think the new internet, the compete with Amazon internet, is going to be good for PayPal. And it's going to be good for Square. Square is doing a very, very good job of small businesses. And I think that you're going to see a renewed small business community in this country in the next couple of years. And every single one of them will be tech savvy. You're not going to have companies that don't have a website or a Facebook page anymore. Not only are they going to have Facebook pages and web pages, but they're going to have a pretty slick online do business with me system. And Square will be a beneficiary of that. They do a lot of business in my daughter's industry, which is she's an esthetician. But I think that the secret here, again, is when we talked about it way back in here, was that they're really cryptocurrency enabled. And I think that cryptocurrency is going to get more popular. I don't think it's a huge investment vehicle, but I do think it's going to become more of a transaction, medium of exchange type of vehicle. Then finally, NVIDIA, another parabolic chart. And Home Depot, not to leave out the non-tech, has gone nuts. Since we've had this easy money tax break era, everything's gone up in value on the stock market, but the economy has been flat to negative. So let's keep that in mind. We know historically the parabolic charts don't work out. So Barbell Investing for the 2020s, let's do a quick review. Path forward from coronavirus. This marks the second wave that I'm very afraid of. Next year, we'll still have lingering economic weakness with potential for inflation due to the monetary policy. And then by 2022, the economy starts to recover in full as people become comfortable with health and finances again. This comes up with something else here in a couple of slides. So deaths from COVID-19, it's not just deaths, but it's excess deaths. So what we're seeing is that, and I talked about this in March and April, is that affiliated deaths and deaths due to those missing treatment for other health issues are mounting. The United States is, not good, but not horrible. A lot of these countries have done horribly. Why is this important to the investor? Because if you don't have confidence to go out, you're not going to be spending. That's bad for the economy. The death rate, which peaked in April, is re-peaking in the United States again. So that's bad. We had over 1,000 deaths again last week, and we will have over 1,000 this week. So again, can the economy recover without a more defined drop in COVID-19 infections and deaths? I don't think so. And what I'm really afraid of is if we do get a wicked second wave in the autumn, because people are inside, that frightens me. So between the kids going back to school and people hanging out inside versus outside when the weather changes, your traditional seasons of passing colds and flus, November, December really just don't look good to me. So the big four indicators for the leading economic indicators all have gotten beat up and staged partial rebounds. But as you can see, none of these rebounds are as straight up as the stock market. Things got far worse than the financial crisis, and we still are not in great shape. This bending over to the right is a bad sign. This really needed to be heading up more. So I don't know how, if this keeps bending at that angle, again, 2022 is probably the earliest that we see 2019 numbers again. Industrial production, non-farm employment, real income. The only thing that came back was retail sales. And that could very largely be due to the increased unemployment and the $1,200 checks. So retail sales are staying up because people are ordering online. They did have a little bit of a glut or inventory hit right here, right? So the stuff that you had in your house started to run out of. And then people, if they have cash because of transfer payments, they're going to spend it. Unemployment benefits are only going to be $300 more, it appears, instead of $600 more. So that's a big hit to income for a lot of people. We bought a kitchen set. We were going to do it anyway, but we just had different money then. It took that $1,200 check. one of them. We only got one. We didn't get two. Real personal consumption expenditures, again, look at where we were to where we are. So household expenditures are projected at $6,000 less per year as of right now. And that will go back up, but it's not going to be by the fourth quarter or even next year. So what does that mean for earnings if revenues aren't going to be growing fast enough? Well, again, I talked about the earnings a second ago. Most companies did beat their lowered expectations, but that means that the expectations are higher now. And as you can see, utilities, healthcare, and technology, the only places where we really had earnings. Then there was some, revenue changes here. And utilities actually had lower revenue, but they made money. A function of being regulated. So healthcare, technology, really the only two sectors that did well. And healthcare largely did well because the government shoveled hundreds of billions of dollars at them. Moderna is the poster child for that. They still don't have a product that really sells, but they made money last quarter. Why? Because the government gave them a bunch of money. Buffett indicator comparing the economy, the GDP to the price of stocks. Again, we are at the second highest level ever, even more expensive than before the financial crisis. We really are mimicking 1999, which came with a 2.5-year recession. The money printer has been turning over. I have that article on Seeking Alpha I think is important. How long will the money printer go burr? Right? This is a popular meme. I think that it's important to understand that liquidity has been the number one thing driving the stock market. And now that people have less household liquidity due to fewer transfer payments, and that the Fed has leveled things off, that indicates we'd probably get a choppy market. So we do know that the markets finally appear to be in topping process. That doesn't mean that they can't go a little higher, right? Fed could, tap the accelerator again. But right now, as of today, breadth was negative today after 5 or 6 weeks of improvement. Financials are lower. Energy and industrials also were back down today. It was technology and consumer names holding things up. And again, I would throw this out there as evidence of why you need to throw away your grandpa stocks. Excuse me. A weekend of talking outside gave me a little bit of a sore throat. The millennials are going to drive this market. Don't fight that. So if you're a boomer, you need to understand that your generation drove the market, right, in the 80s and 90s, and even in the 2000s. From here forward, the millennials are in the driver's seat. You can't ignore the fact that they are steering the stock market and the economy in certain ways. So the oil stocks and things like that, all these companies, smokestack companies, all these companies that the millennials don't like, you need to sell them, and you're getting a chance to sell them right now, with this recovery. So you're not going to want those stocks, especially if Biden wins. You're not going to want to be in smokestack stocks. So smoke often comes from fossil fuels, right? The IEA, EIA, and OPEC all lowered their forecasts again. And it looks like 2022 is the earliest that we'll see 2019 levels of demand for oil. And by 2025, we know that the electric vehicles are coming. Why? Because all the car companies are telling us that. So if they're retooling their factories, it's happening. right? You can't fight that. And if you are, you're just willfully ignorant. The companies that I talked to at the Consumer Electronics Show, every headline you got out there, the GM headline from today about their EV division, look, car companies are going to EV by 2025 because that's part of the law. There's not a way for them to avoid it. So it's all going to happen. So if oil demand, maybe sets a new record high in 2023 and 4, 2025, after that, that's it. Oil demand goes down. It's just the way it's going to be, because new cars sold will be many more EVs being sold. And by 2030, maybe even 2027 or 2028, you're barely going to see ICE vehicles offered, especially at the non-commercial level, right? So you still have your trucks and whatnot, but you're not going to see many sedans out there. OPEC and Russia still rule oil. We can, congratulate ourselves for oil shale all we want, but the reality is that it was never profitable. And given what's happening with technology on the EV front and even fuels for other vehicles, you're just not going to see oil create enough demand to drive prices up in a way that would overwhelm the supply that Saudi Arabia and the Middle East provides. Those countries in the Middle East need that revenue to transition their economies over the next decade. They're going to keep the price of oil in a range, and that range will change. It'll go up a little and go down a little, go up a little. They're not going to allow the shale companies to reemerge. So we're not going to see much more new oil drilling in the Niobrara or in the Bakken or even in Oklahoma. Most new oil drilling will stay in the Permian because that's where the oil is cheapest and best and where the most infrastructure is. A company like Kinder Morgan has done well to drop a couple pipelines there. So what does that mean for most of the oil patch? Most of the oil shale companies, most shale oil stocks are going to zero. That's the way it is. If they don't have primarily a Permian presence, they're done. Continental Resources is in a world of hurt. And you go right down the list. These companies are going to go to zero. The shareholders are going to get wiped out so that the people that own the bonds can be made whole. When people like Harold Hamm sell stock in their own company, you really have got to just wrap your head around that, right? So I think that the hedging that I'm going to do is I'm going to short several shale stocks. I'm already short Exxon because they have to cut their dividend and split the company up. And maybe the Robin Hooders bid it up. Hey, it's going to zero. Let's spend more money for it. But the reality is these stocks are in big trouble. The bankruptcies are already ramping up, even with the price of oil rising. But remember, the price of oil today is high compared to what it was a few months ago. But it's basically in the range where all these bankruptcies happened. We're not going to see $80 oil. And remember, I was the guy thinking that we would. We're not, right? Yes, I am going to consider shorting Occidental. I'm going to figure out what 3 or 4 companies out there I want to short. It's going to be companies without primarily a Permian presence. Occidental's borderline. And because of Icon and Buffett, I have to figure out what that means. But, you take a look at companies like Continental and other ones out there. Did I say Continental? I think that there's companies out there that we can short. So Barbell Investing for the 20s, I'll buzz through this real quick. We want the growth stocks and we want the inflation hedges. Everything else in the middle, oh, who cares? Why would you own this stuff? Why do you want good and mediocre? Focus on the best ideas with the biggest secular themes. Well, we're going to rebuild the world because that's the only thing that's going to save us. And inflation's going to happen because we've printed so much money. And really, we haven't even printed the money yet. We've borrowed against the future, and at some point, we just got to say we can't pay it. Let's just print it. And that's what's going to happen. I think that you might see a Pandemic Recovery and Security Act. PERSA, let's call it PERSA. Pull money out of the PERSA. Pandemic Recovery and Security Act. $15-20 trillion. Buy out all the securities on the Fed balance sheet, stick them in Social Security. Pay for a $2 or $3 trillion Green New Deal. Buy all the coal mines from the coal companies after you ban coal exports and turn them into national parks. Right? There's all sorts of things they can do and rebuild the grid and redo the water infrastructure, but it costs money that we don't have. So how do you get that money? You print it. And the minute you print it and you wipe out all those debts and you have a pile of cash sitting there, it starts to flow into the economy. And what happens then? Inflation. And what you hope is that growth and inflation happen together. Because if you have growth, if you have inflation without growth, which is the path we're on now, we're in trouble. For the last 2 years, I've showed you that the economy was slowing down, peaking out, and slowing down. We need to turn that curve back up on growth. And the only way to do it is to rebuild and build all sorts of new stuff. Can't do supply side trickle down economics in an era where there's no shortage of capital and there's no shortage of supply of end goods. China's got mountains and mountains of stuff for us to buy from them if we really wanted it. That's why it's so cheap. They just make it and make it and make it. There's no shortage of stuff on the planet. The only way for us to fix things is to rebuild a lot of things and a lot of redevelopment. And it has to happen fast. It all has to happen in 20 years. Because otherwise, the debt numbers, I know it's hard for people to wrap their heads around these debt numbers, but the debt is worse today than it was before the financial crisis. And we're trying to paper it over. At some point, you can't. How fast does that come? I don't know. It probably makes sense to solve the problem before it starts killing people. So, tech and tech stocks I want to own. I'm going to use a combination of ETFs and stock selection. QQQ satisfies my need for large caps like Amazon, Google, Microsoft, Apple, and Facebook, which means I'm not going to be buying them unless they really get crushed, right? Would I buy Apple around 300? Sure. Would I buy Amazon, 30 or 40% lower? Sure. Would I buy Google 30 or 40% lower? Sure. But half of this fund, QQQ, is those 5 stocks. So, and I want a taste of all the other things QQQ offers. So I can just buy QQQ for maybe a quarter of my portfolio. Then I can ignore all these giant stocks. Why? Because they're fairly efficient. They move in tandem with the index anyway. There's not a whole lot of point to owning them individually if you buy QQQ. So that's what I'm going to do because it's easy to buy and it's easy to sell, meaning that if I have to trade it, it's a piece of cake. So here's your pre-made basket for 4 basis points or whatever it is, and makes it super easy to trade, and you don't have to keep up with each company. ARK, managed basket of tech stocks that's heavy Tesla. So I don't have to buy Tesla. I can just trade ARK. Very easy to do, and I get a basket that's diversified around 30 or 40 stocks. That's all innovation based. Where I'm going to focus my stock picking on is $3 billion to $15 billion companies that are not yet in the S&P 500, right? They have solid revenue growth, a solid balance sheet, and they're starting to show cash flow generation that can turn into earnings, or that are already turning into earnings. I don't want to do speculative. I don't want to do microcap. There's money to be made there, but the reality is that the big money is at that point in the hockey stick where a company goes from small, medium to big. That jump from a $3 billion company to a 20-something billion dollar company in the S&P 500, that's where the big money is made. That's where you can make your triples and quadruples, and better. Now, you notice that this side is blank. I'm going to write an article for every one of these slides. I'm just going to put the link in this article over the next 2-3 weeks. So I will lay out my entire tech philosophy and the companies, right? So there'd actually be an ebook almost with each one of these slides. Tech savvy industrials. We've talked about one of them already today. So you have to become very acquainted with fourth industrial revolution. You need to understand what that is. I've been talking about it since January. The automation and machine learning that makes processes more efficient. One of the guys I was hanging out with over the weekend, his family owns a company. And he said, if I could just make everything robots, I would. I wouldn't have to deal with people calling in sick. I wouldn't have to do this, that, the other thing. And I said, well, what if you can grow your business double or triple and keep the same number of people working for you? He goes, that would be awesome. And if you don't think that every business guy out there is thinking the same thing, every manager out there thinking, okay, how can I double this business but only add 10% to payroll? That's what they're looking to do. That's why I told you back in March and April, a lot of companies weren't going to hire people back. That's why the hiring numbers haven't really taken off, right? We got the bounce off of the close, off the shutdown, and that's about where we stand now. Consumer discretionary, companies with popular products are always stock leaders. The trick is getting in early enough and then holding on until the final valuation expansion. That's hard to do. And unfortunately, almost every tech-related consumer brand is bid up already, so they're hard to get into. The trick, I think, might be to find rebound stocks of brands that are beaten up specifically due to COVID-19. Again, a year or 2 or 3 from now, I think you're going to see a massive rally once people are like, okay, I've got a job again, I got my shot, let's go on freaking vacation, right? Let's go to Vegas, baby. Let's go to Disney. Finding the next big thing is always worthwhile too, but that's hard to do, right? So if you find the next big thing, let me know. Alternative energy. I think all you really need to know is that the leading industry in the market this year has not been tech. It's been alternative energy. The Invesco Wilder-Hill Clean Energy ETF has been the leading ETF this year. I actually had that on a chart and I took it off. Let's see if I can show it to you real quick. Well, I might not have saved it. In any case, PBW has beaten QQQ. If Biden wins, there's going to be a massive clean energy bill. Even if he doesn't win, the world's already changing. It doesn't matter. But if all of a sudden the government throws $2 trillion at it, you're going to want to be in. You probably want to be in before the election. So you have to make a choice how you want to scale in. I'm going to scale in throughout the after Labor Day period, I think. And I'll probably buy some calls when there's a correction, because I think that owning some of this stuff into about 2022 is going to be pretty attractive. Selling long dated puts might even double your money. So we'll have to keep an eye on what the numbers end up being. Biotech, again, extremely difficult to invest in because you have to understand what's going on at the company. I like the ARC funds. You get about 7 or 8 biotechs in ARC Innovation Fund, or the ARC Genomic Fund is, I think, 30 or 40 companies. So it depends how big of a basket you want, how much concentration you want. If you want to buy stocks looking for home runs, and that's really the only reason to do it. Don't buy a biotech because I think I'm going to beat the market with this one. Screw that. I'm not buying a biotech that could go, down 50% overnight because it can beat the market. I'm buying a biotech that can go down 50% of the night because it can go up 400 or 500% in a year. That's why I'm doing it. So if you want to build your own basket of 5 to 8 companies at about 1% position for each position, and then you can trim the losers and add to the winners, I think that's a good way to do it too. But you have to have the time to really get to know 5 to 8 companies. Now, I do. I know about 10 companies really well right now. And I'm going to pick out which ones I want to invest in. And I'll also own ARK Innovation, but I might add to this Genomic Revolution stock as well. But I will say, even if you don't buy ARKG, take a look at their holdings, right? It's a good place to start your research. Okay, on the inflation side of the barbell, we have REITs. And many people make the huge mistake of buying the Vanguard Real Estate Fund. It has not outperformed anything, ever. Basically tracks the S&P 500. That's a huge mistake to own that fund. Real estate comes in a lot of flavors. You need to understand what you're investing in. The most money to be made in real estate is in the small and mid-cap stocks. Those $2, $3, $4, $5, $10 billion companies that are streamlined and every last thing that they own is profitable. That's where the money is. So again, Dividend Sleuth and I have spent the better part of a year researching REITs while I waited for this big corrective opportunity. And I think that we're going to get our second chance. We're going to get our second dip to buy a bunch of REITs. There's 4 or 5 that I love, and there are 4 or 5 that I think are incredibly interesting. Gold and crypto, I put them together not because they're the same, but because in the psyche of people, they're the same or similar. So I'm not a big believer that cryptocurrencies are like a great investment, even though Bitcoin has done well on the hype. But what I do think is that there's a half a dozen cryptocurrencies out there that if you have savings in the bank, it might make sense for you to take about a quarter of your bank savings and spread it out across a half a dozen cryptocurrencies that have specific characteristics and specific uses. Bitcoin appears to be the winner or a likely winner in consumer transactions. I think it might re-fork into Bitcoin Cash, Ethereum, Lumens. There's a couple out there that you might want to say, okay, well, I got 40 grand in the bank. It's really just there for emergencies. My credit cards are paid off. I'm going to put 10 grand into cryptocurrencies. That's how I think you should use cryptocurrencies. I think that's what it's there for, as a hedge against, not making anything at the bank, basically, and having your currencies slowly devalued. I do think the cryptos will hold their value better, and that's how they're designed. Gold, on the other hand, I think is a trade. It's a position trade that I think lasts for a few more years. And I think that you probably see the gold stocks, the GDX, go up into the 60s. I'm not too concerned that will happen. And in fact, I think that the gold stocks will outperform gold, except for that one spike. There might be a spike in gold that lasts several months. If you can trade that, you probably make a bunch of money. But the reality is that the gold stocks are making money hand over fist just because the price of gold is high. And once that spike in the price of gold happens, probably sell covered calls on all your oil, all your gold stocks, and sell your gold. Right? So we have to look out for that to happen in the next few years. Materials, We've gone through a capital cycle now where materials were underinvested in, even though we still have plenty. We're starting to run low on a lot of things. No shortages, but just tighter markets. And if we get into an expansionary fiscal cycle with governments rebuilding and building, a lot like what Europe just talked about doing, but that'll probably be a tenth of what America spends and China spends, and maybe even in India. You're going to see a lot of the materials tighten up, in particular materials that are relevant to alternative energy. And we talked about a company a year ago now, almost a year ago now, that changed the nature of how batteries are going to be built. They're not all going to be lithium. In fact, the bigger the battery, the less likely it is to be lithium. The biggest batteries that'll probably be lithium in the future, right, are maybe a wall battery for your house, or for your car. But you're not going to see a utility grid scale storage from lithium. It's going to be other materials. And in fact, I think most buildings, because of the way, because you have space, I think are not going to be lithium either in the future. I think lithium is going to be for cars and smaller. And when you finally get a house that has alternative energy, it's going to be from one of these batteries that's basically like a thin refrigerator. And you'll have it up against the wall in your garage or your basement or wherever they put it outside. And that'll be it. One of the companies, a local company, Generac, is getting into that field, and they're expanding the size of the batteries. So you're going to see a rapid arms race in batteries. And I don't know that it's the battery companies that you want to try to make money in. I think it might be the materials that they buy and the companies that mine or develop the materials that they buy, right? You sell the picks and shovels, don't necessarily go and buy the battery company. Companies like Tesla and even Generac are bid way up. So I don't know that that's where the money is to be made. But if we can buy a Freeport McMoran for $10 a share and it goes to 50, hey, we did all right, right? Alternative energy, there's yield in there, so we can get dividends. So between the utilities that are strong in dividends and then other yieldcos and other suppliers, there's plenty of dividend for the dividend investor in here. Plus you get all the growth of alternative energy. I think that this is going to end up being a big space for dividend investors in the future. I think it's just about there now. Then alternative investments, I'll finish up with that. Various asset classes do well after big crashes. Private equity is one of the big ones. Recently, blank check companies or SPACs, special purpose acquisition companies, have been kind of the rage. Nikola was a company that I pointed out to you when it was $11 a share and it was still trading as VTIQ or G or something, I don't know. But before it was Nikola as a stock, there was a blank check company out there run by a GM executive, and he bought Nikola with his pile of money and did a reverse merger, and now Nikola is what it's called, and it's up 400%. Even though they have one order for 2,500 trucks. So, there's a lot of silliness in these valuations. Think back to 1999, in 2000, 2001, 2002, and I would equate what is going on very much to that time period, similar valuations. The event is the pandemic versus the tech crash. And you need to think that this market can get very choppy very soon. And you have to have a plan for what to do with it. So one of my alternative investments for that period is going to be private equity. And I think that we can think of Berkshire Hathaway as a private equity firm. So we talked about Berkshire Hathaway, 2 months ago? 1 to 2 months ago? And it's been up since then. There's, when I do talk about a company specifically, you ought to just say, oh, well, okay, I'll wait for the article or the alert. No, if I mention a company, it means I'm studying it, and you should too. Berkshire Hathaway, I think, with them just selling off a bunch of bank stocks and their airline stocks and accumulating cash and buying the gas pipeline company and the gold, right? What have I been talking about? Gas pipelines and gold for quite a while, right? And tech. I think, blank check. I think that Berkshire Hathaway is very likely to make some major tech acquisitions in the next year or so. So keep an eye on that. So a quick thought to finish. The stock market is in a topping process. It's unlikely to avoid another significant correction this year. Is that going to be 15% or 50%? You got me. I think you should be at the conservative edge of your strategic asset allocation. I've thought this since May. So I was early. That is kind of my MO, to be early. I believe that you need to understand the difference between strategic and tactical. Strategic asset allocation is what you gravitate towards because that's your normal long-term thing. Tactical is what you do in the short term to compensate for what's going on in the economy. And often there's years that go by without you doing much tactically. Right now in this market, I think you have to be tactical. And then when you get fully invested again, you might get to hold on for multiple years without having to make major changes. I don't think that's happened yet. And I think the people who have chased the market, who don't understand hedging, that don't understand why being market neutral has been okay lately, I think you're suffering from FOMO. The idea that things only go up. I remember people telling me in 2006, real estate only goes up. I remember people in 1999 telling me it's different this time. Just telling you, nothing goes up forever, and it's never much different. So we'll get a correction. It'll be significant. It'll be when the reality of the economic damage from coronavirus has set in. When people start to realize, which might not be a lot of people, but when people realize that the way the economy has been run on the top-down, trickle-down supply side economics, much like tax cuts, only are good for a little while at certain points. Supply side only works once in a while when you're short on supply. We're not short on supply. So it doesn't work anymore. Our tax rates are not exorbitantly high. So tax cuts, once they start causing deficits, they're a problem. And there are certain expenses we have that we can't change. Not much anyway. Especially given the lack of responsibility we've shown for the last 40 years financially in this country. So what I want you to understand is that this stock market is on thinner ice than when I said the stock market was on thin ice in January. And right now we're getting pulled out into the middle of a lake with cracks on both sides, thinking, oh, well, maybe the middle will be safer. You ought to head to ground. Get to the conservative edge of your asset allocation and don't worry about missing any of these pops in the market on the upside, because at some point the Federal Reserve can't add much more debt. And in fact, by law, they can't. Why? There's rules that they follow. They were allocated money in the CARES Act to do what they did. Remember I talked about the Armageddon scenario would be a stalemate from government, trade wars taking off, right? And then a wicked second wave of coronavirus. Can anybody tell me that that's not what's lining up right now? Doesn't mean it'll happen, but all these things are lining up. So be careful out there. And I, again, would stress, ignore anything not on the barbell. Just ignore it. Unless you have some special expert level insight into a company, if it's not on the barbell, ignore it. This is where you're going to make your money. This is where you can get alpha. This is where you can use beta to your advantage, right? Volatility, use it to your advantage. You're going to get more volatility soon. All right, I'm going to stop here and I'll take some questions off air. Give me one moment, please.